Hey, everybody. Welcome to the live event. Today's event is a Q&A with me, a CPA, although my hair is making me look a little bit disheveled. It's the rain here in Victoria, but I promise I am a CPA and I do pay my dues and take professional development. Anyways, my name is Joe from Avalon Accounting, and today we're doing a live Q&A. I have a bunch of questions that I've already received through our other social media, but you can post your questions in the comments below, and I will do my best to answer as many as I can. Unfortunately, we usually have Paul in the background here helping me, but he's gallivanting on vacation at the moment. So I'll do my best to answer as many questions as I can and kind of direct you to other resources as I can as well. But thank you so much for joining today. So a little bit of an introduction. My name is Joe Collins, and I am a CPA, and I am an owner at a firm called Avalon Accounting, which is the name of this channel as well. And we do bookkeeping, accounting, and payroll services for small businesses across Canada. And one of our big objectives is to help small business owners thrive by providing educational services as well. So we've got courses, and we also give away a lot of free information through our blog, our YouTube channel, and our social media channels. So follow us along and hopefully learn something. And you can always ask questions at any time to us, and we are really excited to answer as many questions as we can if it helps you be more educated about your business and finances and taxes and all that stuff. So that's what we're here doing today. So actually today's sponsor, and I don't want to dwell on it, but it do help make these kinds of events happen for you. And today's sponsor is Xero. So I just wanted to post that here for you. I'll post it again at the end, but they're offering 75% off for 6 months if you try it out and like it. And it's the bookkeeping software that we use as well. Absolutely love Xero, and they've been a big supporter of Avalon through the years, and are now a sponsor of the channel as well, and sponsoring today's event. So if you can check them out, that's really helpful for us. But I'll mention it again at the end. So if you don't get a chance to scan it now, I'll post it again at the end so you can see it. Awesome. I'm going to get rid of that for now. All right. So I will keep a monitor on the chat here. So as you have questions, please put them in there, and I will do my best to respond to them all. And I do have a list, so I'll be posting these and going through them. But I do wanted to say thank you to Sharon, who became a member of the channel. I'm super excited to offer memberships to the channel. It's just a small way to support us. And the more people we can get, the more content we can do. It's really great. So thank you, Sharon, for being a member and a supporter of our channel. And hello to everybody here. I see Lori and Wes, 1151 Mito. Nice to see you. Thanks for that. I'll start. I'm going to post the question in the below here and kind of go through them in no particular order. I had some I really wanted to cover, and a few, and just in case, so you may have had a question and I might not get to it because number one, I did get a few questions about cross-border tax issues. They're very specific about US forms to be filled out and things like that. I am not a cross-border tax expert, and it would be pretty I don't know, remiss of me to start talking about US tax issues when I don't have that kind of capability. So if you do have cross-border tax issues, I do recommend hiring a cross-border tax specialist to help you with those things. And often they can do consultations and things like that. The person that I see a lot is Phil Hogan. It's just philhogan.com. And he does a lot of cross-border tax issues. And I think he has a channel here on YouTube as well and provides good content. So he's also based out of Victoria, which is kind of cool. But if you do have cross-border tax issues, US tax issues, and especially US and Canada tax issues, he's the guy to talk to. So with that, if I don't get to those questions, that's why. And sorry, I can't be. I know it's a huge issue for a lot of Canadian business owners, but not one that I can really speak to intelligently. I'd be just Googling it. Awesome. So first question I got was, can you explain the difference between the two types of dividends for small businesses or privately owned companies? Yes, absolutely. And it is near and dear to my heart because this is um, really an essential understanding for how the Canadian tax system works. And you'll often hear people say, well, get dividends because you don't pay taxes on the first $40,000 worth of dividends. And that's a partial truth. Like there are circumstances where you would pay no personal taxes on $40,000 of dividend income. What they're not explaining is the corporation that you own already paid some of that tax. So that's where this comes in. So the two types of dividends are eligible and ineligible dividends. Those are two big categories. And what most small business owners will receive are ineligible dividends. So they're because you're taxed at a lower rate as a small business, you get a smaller dividend tax credit on your personal tax return. So the idea here and the way the Canadian tax system works is that there's integration between personal and corporate taxes owing. So you kind of pay the same, roughly the same amount of tax, whether you run your income through a corporation or you run it through your personal. So there's no tax advantage necessarily for the amount of tax that you're going to pay through those two things. But because you can get paid in different ways, dividend or salary, the government needed, the Tax Act needed a way to a mechanism to make sure that the tax is equal on those two sides. Getting a little complicated. Okay, so with ineligible dividends, you pay around, well, it's 9% federal tax and then your provincial tax as well. Here in BC, that's 2%, so 11% total. And you get a dividend tax credit of roughly that amount on your personal tax return. So you get, your income gets grossed up, you get a tax credit for the amount that you paid on corporate tax, and you pay the remainder at the personal tax level. So that's ineligible dividends. Eligible dividends are taxed at a higher rate. They don't get that small business deduction, so they're taxed around 26% at the corporate level, and you get a larger dividend tax credit on the personal side because the corporation's paid more tax. So that tax has already gone to the government. They're just saying you get more on the personal side. So people see this in the public companies as being, I get dividends and I don't pay any tax on it. Kind of. So the corporation's already paid. The corporation that you own, you own a small little bit of that public company, has already paid their taxes on that amount on their income. So you're getting a lesser amount in your dividend because they paid taxes on it. So that's the mechanism there. So those are the two major categories. And I hope that's a simple enough way to understand how they work. For privately owned companies, you get up to $500,000 of net income at the small business tax rate. But there are circumstances where you don't get the small business deduction. So you get a higher dividend tax credit. So I won't get into the details of all of that, but you have this thing called it's a GRIP balance, and it's how much eligible dividends that you have to pay out. That's how that mechanism works. And those are the two major categories. So hopefully that's helpful for whoever asked that question. Thank you for that question, by the way. That's a good one. And yes, near and dear, because the internet's full of, well, you're wrong. They tell me I'm wrong because you don't pay taxes on $40,000 worth of dividends. And like, well, yeah. All right, next question. Can you share tips for beginners that aren't quite big enough to warrant your services, but also want to be in a good place for when they're ready to work with you? Yeah, so if you know anything about Avalon, we're not the cheapest service provider you can possibly find. We're not the most expensive either. I know the big guys charge a lot, but we try to provide a really high quality service. We treat our employees well. We have vacation coverages and all of that. So, that comes with a cost. But we try to make it as approachable as we possibly can because we know small business owners, that they need to make their dollars go as far as possible. However, it still means that we miss out on a lot of small businesses that can't afford our services yet. And it took me a long time to come to grips with that. But what we're trying to do is educate. So we have courses, we have a bookkeeping course and things. So what I would say, if you're just starting out or you're not quite big enough for the budget of hiring a bookkeeper and an accountant and all of that, is to keep things as organized as you possibly can. Learn those things as well as you can, how to do bookkeeping, spend the time in it, because you have only a few resources within yourself and your company. One is time, one is money, and the other is probably energy, because the time bit, if you're doing it too much, like if you're working 60, 80 hours a week, I think, the energy there is going to be tapped at some point. You're not going to be able to do that. So I think any business, like, you should be targeting around $1 million of revenue. If you're not there, like, trying to figure out how your business can get to that size so you can afford these things. Because it doesn't matter if you're a $50,000 a year business or $1 million a year business or a $5 million business. The same sort of things need to be done. So you still have tax compliance, you still have bookkeeping that needs to be updated. You still have HR issues if you have employees. Like, all these things are the same, no matter the size that you are. So it's kind of coming to grips with how big of a revenue amount should you have to sort of disperse all of the expenses that you have. But if you're trying to bridge that gap and get the sales and work up to that, I think it's really important to learn about bookkeeping, learn about HR, employment standards, those kinds of things, because they're so important for your business. But don't necessarily have the money resource. You may have time, you may have energy at the moment to do those things, but spend the time to learn them properly, because what we often see is very big messes that need to be fixed, and that can get very expensive. I think our biggest one was a 14-year catch-up job, and it was a bit scary. But yeah, that's my advice for if you want to be in a good place to hire us. Definitely keep your bookkeeping in order, and you'll keep your year-end costs down as well. Okay, I gotta go back to the chat here because I may be missing something. Okay. Oh, back to the dividends bit. So I'm going to show this comment actually. 11511 Mito. Me and my wife are business owners, and we want to exceed $500,000 each. Is there a proper way to maintain each $500,000 small business limit? Yeah, so it's per company. Although there's association rules as well and things, so you don't get to multiply the $500,000 limit. You might be thinking of lifetime capital gains exemption, so that's per person. You get this lifetime capital gains exemption of around $1 million, and the new budget puts it at 1.25 million. But that's the idea there. So the 500,000 is by the company, and in shared ownership, it wouldn't replicate over companies. So great, you want to exceed that. You just don't get the small business deduction anymore, which means your dividend amount, dividend tax credit can be higher because you're paying eligible dividends. You just pay more at the corporate tax side. And if you're doing that kind of money anyways, I think the government, for small businesses, understand the policy behind why they have a low small business tax rate is they want you to reinvest in your business. They want you to maintain more of your capital so that you can hire more employees. You can buy more equipment. You can do things that make your business more productive. So if you're making more than $500,000, they're saying, you're not a small business anymore. You're a general corporation, and we're going to tax you at a higher rate. So, but not all is lost. You still get the higher dividend tax credit. So integration still applies. No worry there, but that is a consideration. But doesn't replicate. Great question. Oh, here's a good one. Stickman Finance. How do I start an accounting firm like yours? Well, I can give you a little bit of an origin story, but the idea behind Avalon was a lot of accountants don't do bookkeeping and shy away from it. and there's good reason for that. It's not as simple as it looks. It's a whole separate business. It's about hiring talented people, keeping them, training them, making sure that bookkeepers are happy and stay for a long time. So that was a big part of the business. And I thought if you could integrate those things, accounting and bookkeeping and payroll, I think that's an essential component. It it was helpful for the customer, for the client. Like, it was it was a better experience for the client if it could all be in one place, because they don't really care. Bookkeeper, accountant, like, I don't think most business owners care. But really, it was around, if you like, the one thing that I did at the beginning that allowed me to get clients, keep clients, was just reliability. Like, I would do everything that I had said I would do. I would call people back immediately. I would be available. And that was just a lot of hard work at the beginning. And then it's just been learning since then. So it wasn't like I had the perfect plan all the way along. You start out, you do like certain things that are part of your values, which for me were reliability. And that's already set me apart in our market. And then it was just lots and lots of work. So yes. And thank you, Stickman Finance, for your comment here too about integration no longer applying. So um, with capital gains treatment, yes, this can change. It's still proposed. It's not legislation yet, but it's definitely something that's a real concern for many accountants across Canada, that integration is at stake, which is a foundational part of our tax system. Cool. I'm going to get back to questions here. All right. The question was, how can I make my accountant's job easier and better prepared for fiscal year end? So we do have a checklist on our blog, all the things that you can provide to your accountant to make their lives easier. And if they're charging hourly, hopefully get those hours down. Yeah, really, it's just important to be a professional bookkeeper is essentially what it is. And professional bookkeeping is banks are reconciled. Everything is categorized. And I know that's one of the challenges I've always had previously as an accountant before I started my firm, is you get the bookkeeper information and they have a whole laundry list of items that they haven't categorized because they just don't know how to ask the question to the business owner. And for me, bookkeeping, they should know that stuff. Like, you should have everything categorized, or at least like start learning about how to categorize these things. So really everything categorized, keeping capital things separate, knowing how to capitalize items on the balance sheet is super important. And having everything reconciled to the bank statement. So the bank statement matches the bookkeeping, really important. But there is a whole checklist we have on our blog. So check that out. I think that's the place to start. And talk to them. I mean, find out how did it go? I mean, your accountant should be able to tell you, what was missing, and if they can anticipate anything for the following year, kind of work with them to do that. Hopefully they respond. I know it's sometimes they get a little busy and won't respond to questions like that, but they should respond to stuff like that where you can be more efficient. So hopefully that's helpful. Thank you. I did get a question about keeping dividends after. So we're talking about, so the question is, if a couple works for their corporation, can a spouse keep receiving dividends after he or she retires? And I think what we're talking about here is tax on split income. TOSI is a situation where you may have a non-active spouse that is an owner in the business. So they're not active in the business, but they have ownership in the business. And the government a few years ago sort of put a kibosh on that. There used to be a tax planning tool that everyone would use to split income, especially if you had a lower income spouse, to spread your marginal tax rates across two people. That was super helpful and was a cornerstone of why running a business was worthwhile in the first place. But then TOSI came in and essentially shut that down. So I mean, you can still do it. You can pay your spouse dividends, but they're paying the highest marginal tax rate. So it took the benefit of that away. But I did have to look this up, and and somebody correct me in the comments, but my understanding is that once you hit 65 years of age, TOSI no longer applies. So we don't have many clients that are of that age, and we haven't been around long enough to see them go through their whole cycle and retire. But that's my understanding with that one. Double check with your accountant, of course, but my understanding is that you can start to dividend your spouse after 65 because income splitting is allowed at that point. It's good to be old. Let's check the chat here. We did have a live question. Okay. Are there any options or programs to finance acquisitions for individuals without an existing corporation from SD Media? Not that I know of, SD. I haven't seen anything like that. So yeah, I can't be helpful there. It'd be nice if they had more programs like that, but I haven't seen anything like that in Canada. And hopefully we may have some people here in the comments that might know more than me about that. But yeah, don't know that. All right. Okay, I'm going to go back to the preloaded questions here. Okay, when saving for a future down payment on a house, should the savings be invested into a corporate investment account or take the money out of the corporation, invest it personally? So, I mean, this is kind of a depends, but I think the part that depends is like, can you use first time home buyers? I think that's important because that's a tax sheltered program. And the home buyers plan through your RSP as well, tax sheltered, and you can maintain 100% of your original capital with that. In a corporation, remember, you're going to pay some tax on any profit in there, so you're only maintaining a certain portion of your capital. Whereas if you pay that as a salary, use your RSP room, use your home buyers plan, you've essentially held on to 100% of the capital for that. And with a first home savings account as well, it's tax deductible. So you maintain your capital there as well. So I would, until you use those up, I would switch it to personal and use those accounts that are tax sheltered and purpose built for buying your first home. But if it's a second home, third home, future down payment on maybe you've owned a home before, then a corporation could be a place to do it and maintain more of your capital. That's fine, but you will have to take that money out personally and be taxed at that point. So make sure you account for a large lump sum of money being taken out at a particular time, because that's going to affect your marginal tax rates when you do take it out to do your down payment. Good question though, like that. All right. Okay, I like this one too. This is a hot button issue for me. What investments can businesses make with profits? Can they invest in other businesses, lend money, or buy properties? What are the tax implications of business-owned properties? So it's a great question. I think, if you're running a profitable business and you are wondering what to do with the profits, a lot of that you can use your RSP room and things. Again, maintain as much of your original capital as possible. And you can invest in just about anything within your corporation. There's nothing preventing you from doing that. If you are in that situation, I would consider a holding company because of legal implications of that. And if you don't want to mix too much your operating company with other holdings that you have, especially if it's for retirement and things like that. So speaking to a tax specialist about perhaps creating a holding company for that. But one of the things, and this is where I get a little bit hot about, is like, your business, what it does, how much profit you can make. It's obviously profitable if you're having that. why not grow that business further? Like, why not take the next step and invest in your business again? Hire more employees, expand your reach, do that. Work in the business that you know, and you know that provides good returns. Because once you put it into stock market, you don't know the management team or what their future's like. How well do you know what the markets are going to do? And I get it from you want to diversify your portfolio, and I absolutely agree with that. I think if that's the purpose, but there's no lower risk of single investment. I'd say if you're buying stocks, if you're buying ETFs or something that are across industries, fine, you're diversified. But if you're looking at specific stocks of this thing going up or that thing going up, like, understand that you know your business, you know your management team, you are your management team, you know how to make money off of that investment. So don't discount investing in your own business. I think that's it. Properties as well. Like, I mean, we've seen real estate only go up for the longest time, but I mean, it's still a risk. There's still risk associated with it. Buying properties themselves isn't quite the passive investment I think everybody seems to think it is. And why not, if you like real estate, invest in something like a real estate investment trust. I'm not an investment advisor, so you could definitely talk to them about that. But investment income isn't in your corporation isn't taxed beneficially. So there's no real tax purpose to invest inside your corporation other than you maintain more capital within your corporation. So you can invest into more during that time. But there's other considerations like if you are looking to sell your business and want to get the lifetime capital gains exemption, you need active business assets in there for 2 years leading up to the sale. And at sale, there's separate rules for those. So just something to consider there. Invest in yourself, and then if you're really looking like you have a lot of investment opportunity, maybe look at a hold co and speak to a tax specialist about how that would work. Hopefully that's helpful. All right, I'm going to go back to the chat here. All right, Hugo, thanks for your question. Which inventory management tool do you recommend for small businesses that works well with Xero? We buy dry fruits and use it to create beverages. Yeah, so tough. It's a tough one. Inventory management is a challenge. Xero itself, and I think there was another question on this too about inventory management. The very simple inventory management inbuilt with Xero. So if you have anything that's sophisticated at all, you're going to want a specific solution that's inventory management. And we've had success with Sin7. That's been our kind of go-to for e-commerce. For manufacturing, we don't work with a lot of manufacturing companies, so hard to say. It just takes a lot of management, I would say. Lightspeed, no, I don't think it's great. Sin7 seems to be the most robust one. And they had a competitor that they bought out not too long ago, a couple years ago. But yeah, that's the place to look. I think Sin7 is kind of the standard for small business inventory management. Great question. Okay. I'll take another one from the comments here. Thanks, Anand. I have roughly $100,000 Canadian in profits this year in my CCPC, which is Canadian Controlled Private Corporation, and I want to acquire a small business with that capital. Is there a way to structure the deal, shares assets, which gives tax relief? I mean, if you're maintaining the profits within the CCPC, you're going to hang on to north of 80% of your capital. So you still pay tax on the income. As far as like structuring the deal for tax relief, I think I wouldn't be able to say on a call like this, but I would recommend speaking to a tax specialist to see if they can structure it in a certain way. If you're going to own the shares within the corporation and the corporation's going to be the owner, yeah, there can be ways to do that, and it depends how much. Like you may want to amalgamate that company into yours later. I'm not sure exactly. And on a call like this, there's so many more details to go through on a question like that. But appreciate the question. But yeah, I think keeping as much capital as you can to for the purchase price is good. And if it's loans or things to buy the company, that's another consideration. But sorry, I can't be more helpful there. All right, and go back to the other questions here. Oh yeah, so that was the question. It was the next one. Is Zero a good software for tracking inventory? This is good. Okay, so it looks like we had the same one. Okay, only 6 SKUs. Yeah, and so Zero might work for this. If it's only 6 SKUs, and I would try out Zero's inventory management because it is made for a small number of SKUs, and you can kind of manually update the pricing, the way you buy things and what you sell them for. So that would be a consideration for you. Yeah, absolutely. Thank you for that question. What are your thoughts on having your personal and business taxes done by 2 separate accountants? Good or bad? I'm kind of indifferent on this one, to be honest. I think if well, I can see different scenarios. We do the personal taxes for a lot of our business owners, and it's helpful because we know what their dividends are getting paid. We can talk about tax planning, and it's seamless, and then we can execute on that tax plan. So that makes a lot of sense. I think if you can do those two things with one accountant, I don't think it's absolutely critical, and it depends on your personal tax situation. So if it is you're just a salaried employee of your corporation, probably not a lot to do there. And you could probably do your tax return yourself, to be honest. But if there's tax planning things that you want done, I would suggest you use the person who does your business taxes to do your personal taxes as well. I think it's a seamless sort of integration, and hopefully they have a good system for combining those two things. Yeah. Thank you for that. We had a question here. So I have a business in Ontario that receives payments from international customers in US dollars. I would like to pay myself in US dollars. What is the acceptable exchange rate I can use when I report my Canadian income? So a couple ways to do this. Number one would be you can use the exchange rate of the date of the transaction and just record those throughout the year. That's one way to do it. The other is you can use an average rate. So CRA allows for an average rate throughout the year, which Bank of Canada posts on their website. I think you have to download a PDF, at least you used to. I haven't done that in a while. But there's an average rate that you could use that sort of weighted averages the exchange rates for the year, and you could use that. Both are acceptable. Next question. All right. All right. Question 10. I have claimed my lifetime capital gains a few years ago. Will I be able to claim the additional increase in the lifetime capital gains exemption? Yeah, so that keeps increasing. If you do it again, you still get it. It doesn't go away if you use 100% of it, you don't miss out on the other bit. But you can't go retrospectively and change it up, I don't think. So yeah, definitely when they increase it to 1.25 million, you've got another, 250,000 to play with or thereabouts. And now it's up there. Yeah, should be all good. All right, we're renovating 2 houses and will be done after the fiscal year. When should we recognize revenue? At sale or percentage of cost? My accountant suggests recognizing costs now, but I want to avoid paying taxes on uncollected revenue. Yeah, so there's no revenue until the sale actually occurs. Like it could sit there for years. So I don't know. Maybe your accountant's talking about something else. Like it could be an accounting type thing they're talking about. But for tax purposes, like the sale hasn't happened until you sell the two properties, and I assume that's what you're doing, renovating the two houses. Um, but are you okay? What I need to know, I'm reading this as renovating and then flipping the houses. So, but if it's just you're renovating someone else's house and they've paid you throughout, then yes, it would be a sort of percentage of completion would be the likely method of your revenue recognition. And hopefully you're getting paid throughout, so you don't have a massive amount of receivable at the end. But if it's a flip, then the revenue doesn't actually occur until you've sold the place. So it would be at the end. But otherwise, if it's you're doing the work throughout, you've already completed the sale, they've signed a contract and you're incurring expenses on their behalf, that it would be sort of percentage of completion to recognize the revenue throughout. But hopefully you get the cash throughout. I wouldn't want to leave that to the end. So that could just be a business operational issue if you haven't collected, even though you've sold them the renovation. Yeah, something to watch for there. All right, I had a question. Are short-term and long-term capital gains treated in the same manner within a corporation with respect to investment income tax? I think so. I've never heard this question come up. So I'm trying to read into it maybe too much, but if there's some other considerations around, house flipping or something might be the real question behind this. But otherwise, capital gains are capital gains. Doesn't really matter how long you've held on to a property or an investment. But there may be specific rules on houses, so I'd watch for that. That's why I'm a little hesitant to answer that. I'm not sure if we're talking about flipping houses, which there are some special rules for, but in general, short-term, long-term capital gains, no difference. It's still the difference between proceeds and your cost. All right. Another question. Can a refund claim be submitted if a non-arm's length employee or shareholder has been paying into EI, even though they would not qualify for a claim if made? Yes. So it has happened in the past, and we've done this before. And I can't remember the form that needs to be filled out. There's a number to it, but you can. So if it's got to be 40% or more ownership. There are considerations if we've had exceptions where somebody has owned like 15%, but has a lot more say in the business, run operations, HR. They can't really be fired from their own position because they're the firer and an owner in the company. So it's like significant, what do they call it? Significant influence in the business. But the general rule is owning 40% or more of the shares. And if that's the case and you've been paying into EI for a while, you can get that money back both for the company and for yourself. There is a form, and you just have to Google that. But there is a form to fill out, and you can get that EI money back. Almost considered doing this as a service for some of our new clients coming on at one point, because I saw like 3 or 4 or 5 of them come through in a short period of time, and we process those, but I haven't seen one in a while. And I'm off the tools a little bit more than I used to be. So could be the case. Okay. I'm going to do the last one from the pre ones, and then I'll get back to the comments, but this is the last question for the ones that came in before. My OpCo's shares are in a trust, planning to name beneficiaries to use their lifetime capital gains exemption in the event of an exit. Any tax code updates in the last 4 years affecting this strategy? Not that I know of, but again, anytime you're talking about this kind of money, and this is why I wanted to answer this question, I don't have the answer to this specifically, and going through how trust's been affected over the last 4 years. It's a challenging way to go research something. But what I say is, if you are dealing with this level of money, for a number of lifetime capital gains exemptions, you have a trust, and all of that, it's worthwhile to seek tax specialist knowledge on this to make sure that you're not falling afoul of anything that's changed in the last while. There's tax specialists that keep their beat on this all the time. I'm more of a generalist, so I keep tabs on things that are happening, but there's so much detail and minutia to tax changes and tax interpretation. So a tax specialist will be watching um, tax court decisions, how the law is being interpreted, not just rewritten, but interpreted through the courts. So really important to engage with those kind of people, because that's what they do day in and day out. So that's my sort of plug for having a tax specialist. If you have questions like that, and you're talking about this volume of cash and potential tax owing, really take the time to hire a specialist, invest in their advice, and avoid pitfalls that way. So yeah, that's my advice there. I'm sorry I can't answer that specifically. It's a bit tough to do, but yeah, do speak to a specialist on that one. Okay, I'm going to back to the chat here. See what else has come up. All right, so another question from 11511. I wonder if with the new capital gains tax personal name rather than a corporation, since the inclusion rate will remain at 50% for the first 250,000. Yeah, it's going to be interesting how these are all interpreted. I mean, after the legislation passes, so talk about that. And I know June 24th is kind of the date they're going to be instituting all of the changes. But yeah, I'm not sure exactly how it's going to play out. Do you buy more assets personally? I mean, probably to a little bit more of an extent than it was in the past, because the corporations, I mean, we always had, we're not keeping a lot of capital within the corporation. Lots of times, not all the time, but a lot of times from what I see. And then, so because there's not like tax advantaged investment income there. But yes, this may push more money out to the personal side. And that's going to be just a new calculation you have to do on the future tax implications between the two. It's just another consideration to take into account with everybody's individual circumstances and marginal tax rates and things at the personal side, because you want to hold on to more capital at the beginning, because you start with a larger piece of the pie and it can grow, versus if you're taxed at a really high marginal tax rate, yes, your capital gains might be lower later on the first 250,000, but you may have started with a lot less capital because you paid those marginal tax rates. So interesting. I'm not sure how it's going to pan out, and it will be kind of individual based on what they're looking at and what the gains can be. And it's always scenario building on that stuff. So good question though. Thank you. All right. All right. Accounting learning. All right. I would like to learn T2. So that's a corporate tax return. Can you please give me a solution how I can learn properly and completely? Thanks. So I like this question, accounting learning. It's been a course that we've been trying to do for a really long time, and I abandoned it a little while ago, and I'll tell you why. I wanted a simple solution that business owners could use, like a T2 software like UFile, and be able to walk that through. And I had come up with 80% of the course, and we were getting to the final stages of that. And there were so many exceptions and things to look for and watch for, and it became kind of like, this is becoming an accounting course, because you have to start with accounting income first. So you got to do the accounting first, and then you do the corporate tax return. And so it became really difficult to template it in any way. message out all of the details that would need to be known. So the solution that I can say to properly learn it is to do like a Athabasca College or another maybe online university course on personal and corporate taxes, and how to, and then do practical ones for filling out a return. So I tried and it was like, okay, this is simple and I get it. Like it's a simple business and you should be able to do it. But I think those are the options. It's almost like go and study accounting really it was the answer. And I wasn't kind of trying to build an accounting course, but it just became such go figure out this bit and, oh, you have to check for this. And if you have this, you might want to hire an accountant because there's some things that go on here that you would be a whole other course to cover. So really challenging. I found it really challenging to do that course and not do it in a way that was a disservice to somebody that would buy that course and be like, well, this doesn't apply to me because of this, and this anyways. And I found it was going to be the list of people that it would be useful for just got smaller and smaller and smaller, even though they may buy the course because they think their stuff is easy. There is so much that goes into it. And I guess we're not in the business of training accountants. So it became like, okay, what are we doing here? But I like the question. Thank you so much. And it is, I think, a matter of learning the accounting from the ground up, and then how to apply that to the tax side of it as well, or do a practical course on that side too. Thanks for the question. All right. Let's see. All right, Michael, good question. If you give a client a discount, can you write off the discount? Yeah, so it doesn't even come into account. The revenue is what you're invoicing for, and it's the total amount that you're charging. Discount you don't even have to like put that in your tax return or anything as a write-off. It's just the revenue is what you're actually charging your client. So no issue with that. Yeah. It's you don't have to do it on the growth or what you would charge. Otherwise, people would just say they charge less. I don't know. It's revenue is the money you're expecting to get paid for your services, and discounts don't really play into account. Nice. I think I covered any. Give me a ping on the bottom here if I missed a question of yours that you'd like answered. And I am here for a little bit longer as well, so you can keep the questions coming. While we're waiting, though, I will just say one more time that Xero is sponsoring today's event. So I promised to put up this QR code again. So if you are looking at a bookkeeping software like QuickBooks, but Xero is our preferred software provider for small business bookkeeping and accounting, and they're offering 75% off your first 6 months, which is a better deal than I get. So yeah, if you're looking at trying it, that's a good time to do it. And we do have a course as well on that. You can check out I've got that right here. And we've got 40% off right now. So if you take that course, it shows you how to use Xero in our whole method. So you can go check that out as well. So really appreciate that. And okay, is there another? Yeah, thanks, Hugo. Yeah, so on sale, like the sale happens at the end. That's when the revenue occurs. So no need to claim revenue throughout your renovation. That's all your cost. So all good there. Evan, actually, I'm not sure on this. Evan, is the accelerated depreciation for CCPCs not available from this year on? And this is where I would usually say, hey, Paul, can you can you go do some background research and get us a post on this? I haven't done my tax update this year, so I'm not sure how long that off the top of my head, how long that applies for. But hopefully Google search could get that going, or somebody has the answer here. Super helpful. But I have a guess, but I don't want to say the wrong thing on here. Cool. I'll give you a couple more QR codes. You can join our channel like Sharon did. Be like Sharon and support the channel if you can. Really helpful for us to know that we're doing the right things here and providing value to small business owners in Canada, and it helps keep us going. Thank you so much. And if you want, we have another event coming up shortly. In June, I'm going to be talking to an investment advisor about retirement and CPP and investing and all that kind of stuff. And I'll give it a business owner spin, but it's generalized for everybody. And that's coming up next. So if you want to be notified of that, you can get our event updates as well. That can be valuable for you, hopefully. And don't miss an event. But these are recorded and posted to our YouTube channel as well. So if you miss something or want to catch up later, they do get posted automatically right after the event within an hour or so. So all good there. Go back to the chat. Okay. Evan, you're asking the doozies. Okay, under what circumstances is it good to file a Section 8911 election not to be taxed as a CCPC? It's a good question. I don't know. I don't think I've ever filed under that section. I feel like you have more info. If you have some context there, maybe that would be helpful. I haven't used that election before, and I honestly, out of a lot of the tax filings these days, so not sure about that particular section. But if you have more context there, I'm going to share. Sounds like you may have some background there. Thanks, Evan. Awesome. Well, I think that's all the questions, unless Evan has his other comment here. But thanks so much for joining today, everybody. And again, thanks to Xero for sponsoring the event. I'm really happy that they're doing that these days. It's been really helpful for keep the channel going and everything. And your support means so much to us. Keep the questions coming. We're trying to do as many videos as we possibly can about stuff that actually matters to you. I want to make sure this is relevant content for small business owners in Canada to sort of demystify and know what they're up against. Sometimes it's a lot of battle. I was on Reddit just before jumping on here, and they're talking about bad employers in Victoria, and I was like, all right. And a lot of it's blaming business owners for being mean, but I know we're also under a lot of challenges. Because of just the way we have to structure our businesses and remain profitable and keep our businesses going. So I know there's often a lot of misunderstanding when it comes to what the pressures that we're under. So if we can stick together and make sure we do a better job, we can be better employers and better community members and still manage to be profitable and enjoy our lives and all that sort of stuff as well. So yeah, so that's kind of the big one. All right, Evan, just a question of having more than one operating company with profits that would exceed. Yeah, and I think you're forced into that anyways, Evan. And you can choose which one you're allocating to. So if you have business partners, that can be challenging, who gets a small business deduction, but something to be negotiated. But if you own both of those companies, oh yeah, no, sorry, Evan, it's not difficult. They're just good ones. Keeping on my toes. So yeah, so you're kind of forced into choosing where you're going to use your small business deduction if you own multiple companies, related companies that have to share the small business deduction across them. So definitely worthwhile thinking about, and sometimes can be a negotiation between owners too, where you're going to put that. But yeah, good question. and great questions. All right. Biju, thanks for the question. Did you start the business yourself and then choose a partner later? How did you select a partner or convince them to partner with you? Yeah, so it's a great question. I like it. Gives me a chance to praise Paul. So I mentioned Paul a couple times on this call already. He's usually in the background answering more technical questions that come up that I don't know off the top of my head. So yeah, I did start the business on my own. Got my first few clients and worked away as hard as I could. I'm more of a big picture thinker, not necessarily the nitty gritty as you may have found in some of these calls. Like when it comes to sections of the act or really detailed stuff like that, like I'm not the best accountant for that. I know generalized information, but what happened with Paul is I had known him before I started the business, and I was always calling him to get his advice on things like, am I crazy about this thing, like for the business? So I'd call him and try to get his 2 cents on where my head was at. And when the business grew to a size, um, uh, it was time to hire somebody to like help me with this stuff, the tax stuff and he had a lot more experience in that area. So it became almost a no-brainer for me. So if you're in this situation of trying to find a partner for your business, and it is really, it's like a marriage. Like you have to kind of, have unspoken things, and everyone is, sometimes you're chipping in, sometimes they're chipping in, and have that mutual trust and understanding. Very difficult to do. But what I would say is that networking is super important with that, and you get a feel for people. Paul and I have been partners for 7 years, and we have John as another partner, and Charmaine just bought into the business. So we've got now 4 owners, although Paul and I are the majority owners. And it was really knowing that I could trust him early on, and he was the person I was already talking to about this stuff, and it became the right situation for us. So it wasn't a big convincing, to be honest, because we'd already been chatting about the issues with the business and things, but um, and we saw the potential in that. We shared a vision of what it could be. So I would almost say, Bijou, like select the partner, sure, but don't try to convince them. I think you can share your vision for what you're trying to build, and if they grasp that and agree with that stuff, that's a good indication that you can be a good partner. If you're trying to convince them and do a big sales pitch on them, and you're maybe showing it in the best possible light and not all the challenges that come across with it, and probably a good sign that it wouldn't be a good partnership. You should be able to kind of try to scare them away, but they still want to be a partner. And that's the situation I was in. So yeah, hopefully that's helpful. And again, Evan, I just read your comment again, and I'm not saying you're being difficult at all. Thank you so much for your questions. It's really good. Yeah, and another point: if your business partner is a U.S. resident, but it's just Canadian controlled private corporation, you can get the small business deduction. That's okay. And as long as they're a minority and you control, and that's all good, you can still get the CCPC status and things. Awesome. Well, thanks everybody. Happy Friday. Enjoy your weekend. And hopefully see you guys on the next one here. Really appreciate you taking the time to join us today, and all your great questions. Hopefully something's been of value to you, and really appreciate all of you, and really enjoy doing these as well. So thanks so much, and take care.